Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Todd. Alan, is it true that options is a zero-sum game? If so, if covered call writers are more likely to make money in the long run, who are buying these options and taking predominantly losing positions? Thanks, Todd. Well, isn't that an interesting question? And we do get it frequently. If we're generating income on a consistent basis by selling options, which we are, who are these folks that are buying our options and seemingly losing money in the long run? Well, the answer is that's simply not the case. But let's explore. First, let's have a look at a strategy that is, in fact, a zero-sum game, and that's futures trading. Because here the trader is betting on market direction. So if they buy a call option and the option goes up because the market is going up, then there's an opportunity to generate profit. If somebody took the opposite position and was betting that the market was going down, they would then lose money. So it is in fact a zero-sum game. But that's not the case with trading equity options, because there your short positions can be hedged with the underlying security as it is with covered call writing. So in that case, we're long the stock, we're short the option. So the question becomes, is it possible for both the call buyer and the call seller, that's us, to make money with the same options contract in the same month, same expiration, same stock? So let's evaluate. In this particular hypothetical that we're going to set up, we're going to use stock BCI, which is my favorite non-stock. It's kind of a make-believe stock. And we're going to say it's trading at $29 a share. Now, if we're bullish on the stock, and certainly somebody buying a call option is going to be bullish on the stock because that's why they're buying the call option. They anticipate share appreciation, thereby causing the value of their option premium to also go up in value. Let's assume that the covered call writer is also bullish on that particular security for that particular expiration. Now, in this hypothetical, the call buyer is going to buy the option for $1, and the covered call writer is going to buy the stock for $29 and sell the $30 out of the money strike for $1. Now, once again, the reason the out of the money strike was selected is because we're bullish on that particular stock at that particular point in time, and by selling the out of the money strike, we'll have an opportunity to generate two income streams in the same month on the same stock with the same cash, one from the sale of the option and the other from share appreciation from current market value of $29 up to the $30 strike price. Now, we're also going to make an assumption that both were right and the price of the stock did in fact go up to $32. So let's see how both the call buyer and the call seller did and see if it's possible for both to actually generate a profit. All right, in this particular screenshot now, you see on the left side of this comparison chart the call buyer, and the right side of the screenshot is the covered call writer. Now, the call buyer, once again, has an initial investment of $100, $1 a share times the 100 shares that comprise one options contract. The final value is a minimum of $200 because the strike price of $30 is at least $2 in the money from the current market value of $32. So the intrinsic value component of the 30 strike is going to be $2. Even assuming no time value whatsoever, the minimum that the call buyer is going to generate is $200, which is a $100 profit over the investment of $100, thereby a 100% 1 month return. Not so bad. Now, on the right side of the screenshot of this comparison chart is the covered call writer. Remember, the initial investment was $2,900. The final value is not $3,200 because of the option obligation to sell at $30. So the contract is worth $3,000. That's the final value. Now, the total profit is $1 from the sale of the option and $1 from share appreciation from 29 to 30 times 100. So a total of $200 profit on a cost basis of $2,900, and that represents a 6.9% 1 month return. Also not so bad. So let's summarize. Trading equity options is definitely not a zero-sum game. And the reason has to do with the fact that the short positions can be hedged with the long stock or ETF positions. So both the buyers and the sellers of options can actually win or lose with the very same options contract. There will be some times in between where one will make money and the other will lose money, but the big takeaway here is that trading equity options, and in particular covered call writing, is definitely not a zero-sum game. So Todd, thank you very much for giving me the opportunity to respond to that question, because it is asked pretty frequently. So I appreciate it very much. And of course, thanks to everybody out there in our audience for taking the time to view this video. Hope you enjoyed it and hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.